Hello, I'm Alicia Ogawa, Director of the Program on Japanese Corporate Governance and Stewardship at the Center on Japanese Economy and Business at Columbia Business School. That's always a mouthful. Good evening to everybody tuning in from my side of the globe, and good morning to all our friends in Japan and elsewhere. This is our program's first event since the summer began, so I want to say that I hope all of you enjoyed a safe and happy summer, and I hope we'll all be seeing each other in person very soon. Tonight's program focuses on a topic which is extraordinary in its scope and also in its critical relationship to the future of our society and our planet. And we're indeed extremely fortunate to have two speakers who have been thinking about, writing about, and actively working on these issues for decades. John Lukomnik, who is a renowned expert in corporate governance issues, has just published a book examining the limitations of modern portfolio theory, which currently forms the basis of the financial industry's approach to investing. And he makes a very compelling case that building a new framework is in the self-interest of all players. Fiona Stewart of the World Bank has long been at the center of several movements to unify pension funds and other large-scale asset owners around global issues of environment and equality. Both Fiona and John offer compelling arguments proving that asset owners need to work to solve global issues, not simply to do good, but in order to preserve the value of their investments. To sum up our topic tonight, what are the roles and responsibilities of asset owners, of the financial industry, and of governments in developing solutions to the issues that threaten our physical existence and our ability to function as a society? Why is it in the self-interest of asset owners to help solve these problems? And what possibilities can we imagine for public-private cooperation in taking on these challenges? Fans of this program may be a bit puzzled by the departure from our usual format. The purpose of our program at CJEB is to present the best practices in governance and stewardship from both Japan and the US. I've always taken this approach in the hopes of creating a dialogue where each side can benefit from the other's experience. Tonight's program is slightly different for reasons I think are worth talking about. First of all, the questions we're debating tonight require a global, not a local approach. Secondly, I think Japan is a bit of an outlier in this discussion. One of the challenges of the pandemic has been the inability for people like me to visit Japan for almost 2 years now. And because of that, I know that I'm probably missing many important trends happening quietly on the ground in Tokyo. And so it's very possible that I'm simply not aware of recent trends. But I must say, I have had great difficulty in finding people who are speaking or writing on these new issues of financial theory in Japan. And that's somewhat ironic because, as John Lukomnik points out, it was GPIF who was one of the first actors to realize that due to its size, it had to be a leader in tackling ESG issues if it wanted to preserve the value of its own portfolio. And it was Fiona who authored one of the early comprehensive papers on ESG factors in the bond markets, which was in fact commissioned by GPIF. But I think there are good reasons to explain why Japan has not been a leader in financial markets theory, although it is clearly a leader in many others of science and technology. The first explanation is that business schools and courses in security analysis and portfolio composition have a much shorter history in Japan than in Europe, the UK, and the US. But the second and the more powerful explanation, I think, is a long history of investments in Japan being made for relationship purposes rather than investment purposes. When you own securities chiefly to protect existing business relationships, it's obviously a waste of time and resources to monitor and analyze the value of such securities. Of course, this has been rapidly changing since the 1990s, but I think it explains why portfolio management theories are less powerful among practitioners in Japan than in some other markets. And I don't mean this as a criticism, it's just an observation. And on the one hand, it's wonderful that Japan's FSA is taking a global lead in requiring that prime market TSE listed companies should disclose climate data in accordance with TCFD standards from next year. On the other hand, I see an opportunity for Japan that I hope will not be missed. I fear that Japan has not been vocal enough at the organizations that are setting priorities, standards, and reporting metrics for ESG issues. Western points of view have dominated a lot of these institutions and organizations. For example, features of the lifetime employment system, the tax system, and the social safety net have determined what sorts of progress Japan can make on issues of diversity and employee inclusion. This is not generally well understood outside Japan. Japan needs to do a better job at communicating its own circumstances to the rest of the world. And Japan needs to define its own measures of accountability. Otherwise, it will end up being judged by the standards of other societies. So Japan has much to contribute to the discussion, and it has a responsibility to do so. Therefore, I hope our Japanese friends viewing this event will be inspired by our speakers tonight to start a discussion among their friends and business colleagues, to think about the opportunities for Japan to lead in the initiatives that John and Fiona are about to discuss with us. And I hope that the managers of Japanese companies will understand, for reasons our speakers will explain, that all investors need to be activists these days, and that both sides need to engage with each other. As is usually the case with our speakers, their bios contain too many accomplishments for me to list them in full here. We'd have no time for discussion, but please do read them online. Just to make it short, John Lukomnik has been an investment advisor or trustee for more than $100 billion in assets, including the New York City pension funds. As for Fiona Stewart, well, I know her from her time as head of American Express Asset Management in Japan, where she was in charge of Asian equities. She's currently with the World Bank's Global Capital Markets Group, where she has been working and writing about roles that pension funds have to play in meeting environmental and social goals. She's active in the Climate Action 100 Plus, and she's now proposing a Nature Action 100 to protect biodiversity. So very quickly, the housekeeping is very small. Please use the Q&A function, not the chat, to list your questions. Each of our speakers will speak for about 10 minutes each, and then we'll open it up to general discussion and Q&A. So I'm looking forward to all of this very much. I'm going to turn it over to John Lukomnik to kick off the discussion. John, take it away.
Thanks so much, Alicia. And my thanks to the Columbia Center on Japanese Economy and Business for inviting Fiona and me to present. If I could have my first slide, please. There we go. Let me set the context for this discussion with an explanation of why I think addressing market risk is turning investors into ESG advocates. The book Professor Jim Hawley and I wrote, Moving Beyond Modern Portfolio Theory, Investing That Matters, admittedly has an ambitious goal, redefining investing, precisely because we observed that investors were increasingly addressing issues like climate change, mining safety, the governance of technology, biodiversity. And we wanted to understand the financial reasons why. Next slide, please. For 70 years, investing has largely been defined by modern portfolio theory, or MPT. When people think of MPT, they think of diversification. But Harry Markowitz, the father of MPT, didn't invent diversification. Miguel Cervantes beat Markowitz to the punch by a third of a millennium when he wrote Don't Put All Your Eggs in One Basket in Don Quixote in 1605. But what Markowitz did was give us the math to make diversification effective and efficient. And make no mistake about it, that created a revolution. MPT created the demand for prepackaged diversification that led to mutual funds, index funds, ETF. The institutionalization of the investment marketplace wouldn't exist without MPT. MPT has affected most of what constitutes the capital markets today. Next slide, please. MPT's math is enabled by three theories. First, next slide, please. I think this is an old deck, so we'll adjust. First is economic rationality, which means that humans are risk adverse, valuing potential opportunity and potential loss equally. But we know that's not true from a later Nobel Prize winner, behavioral finance pioneer Daniel Kahneman, who with Amos Tversky proved that humans are loss adverse, not risk adverse. In other words, there's truth to the old saying that we think a bird in the hand is worth two in the bush. Next slide, please. The second enabling theory, updated a little bit here to have someone looking for a Bitcoin rather than a $20 bill, is random thought, the idea that the next movement of any security is not predictable. In other words, there's no path dependency. The drunkard wanders around the light. But if we are loss adverse, as Kahneman and Tversky proved, then there's path dependency. You have to know how much you paid for security to know if you had a loss. And so movements around that price are not random. Expand that to the market writ large, and you have the basis for the charting of security prices. Other non-random predictable events include contagion events or financial intersectionality. For instance, when high-quality liquid securities are sold during crises because there's an impaired market for riskier securities, thereby spreading risk to a number of markets beside the one where the risk originated. Next slide, please. Finally, there's the Bitcoin. There is the efficient market hypothesis. There are weaker and stronger versions of this, but all versions say that the market absorbs and acts upon knowable information. Efficient market hypothesis, or EMH, has been rightly criticized for decades. And I'll just point out that if EMH were correct, there would be no arbitrage situations that last more than milliseconds and no need for insider trading laws. Next slide, please. Together, these three enabling theories serve a purpose which is both elegant and troubling. They insulate MPT from having to deal with the real world and all its complexities. That makes the math of MPT elegant. It doesn't have to deal with the issues these theories assume away. In effect, the three combine to create the perfect myth. Easily understood, remarkably explanative, logical, and wrong. Next slide, please. But myths have power. In the book, we call this being performative. The theory becomes true because people believe it and act upon it. For MPT, the result has been to create a self-referential investing dynamic. We measure success relative to the capital market, not to real-world needs. So we measure whether a portfolio has beaten the S&P 500, not whether you are more or less able to retire, to buy a home, or to pay for college. According to MPT, the role of the investor is to extract the best risk-return portfolio from the existing marketplace, rather than consider how the market itself can be improved. So if you're only down 8% in a down 10% overall market, you've succeeded, at least in an MPT sense. You've outperformed by 200 basis points. But in the real world, you only have 92 cents on the dollar to retire on or buy that home. That lack of concern with the real world extends to the factors that affect the market, such as how MPT thinks about risk. To MPT, risk is only volatility, the predicted variation in the price of a security. MPT doesn't care if the source of the risk is the normal to and fro of the economy, or global financial crisis, or an individual company performing well or poorly, or the pandemic, or income inequality, or lack of diversity on boards and executive suites of the companies in which we invest, or climate change. As human beings, we may care, and I certainly hope we care, for workers in stressed economies, for the societal fraying that comes from high levels of income inequality, for the essential unfairness of gender, racial, ethnic, or sexual orientation discrimination, and for lives lost in conflict areas, and for our planet. But MPT is in fact bloodless. For MPT, the only thing that matters is those risks create price volatility. Next slide, please. The problem for MPT is that many of those real-world stresses create systemic risks that affect the entire market, not idiosyncratic risks that affect different securities differently. Markets are driven by systemic real-world risks more than by idiosyncratic risks. And that's the MPT paradox. Even if you're only concerned with financial risk and return and couldn't care less about climate change or human rights or deforestation or any of the other systemic risks, the fact of the matter is that idiosyncratic risks, the type you can diversify with MPT, only account for 6 to 25% of the variation in your return, depending on which academic study you look at. The rest, 75 to 94% of your return, depends on systemic facts that create non-diversifiable risk. That non-diversifiable risk is caused by real-world issues. Some affect virtually every security, such as climate change, income inequality, and societal unrest. And some affect specific industries, such as how to deal with mining waste, the governance of artificial intelligence and social media, or how to deal with the growth of antibiotic-resistant bacteria in the food and medical industries. But they all affect broad swaths of the market and are all created by real-world actions or inactions. Now, MPT asserts your portfolio is a one-way valve. Those real-world impacts on the market affect you, but your portfolio can't affect them. I understand why they result in non-diversifiable risk, so the only tool MPT has, which is diversification, doesn't work. But that doesn't mean investors can't affect them. It just means that the definition of investing has to change to include more than MPT-oriented activities, such as security analysis, trading, portfolio construction, and risk management. Next slide, please. And that is exactly what today's investors do. They engage in the real world beyond the Bloomberg trading screen. They lobby for better governmental policy around issues such as climate change. They encourage companies to report according to SASB and TCFD, or to increase gender diversity on their boards. They effectively set standards for corporate conduct. They create products and portfolios to impact issues like income inequality. They build coalitions to set guardrails around how mining and extractive industry should act so as to prevent another tailings dam disaster like the one that killed 259 people in Brazil. I cite those examples to illustrate that whereas MPT provides risk control through diversification of idiosyncratic risk in the capital markets, systems level investors, today's investors, increasingly mitigate systemic risks by intervening in the real world before those risks metastasize and affect the capital markets. This is the financial reason why investors have become ESG advocates. Yes, we care about people and planet, but we also act because combating climate change, unsafe extracted industries, or the growth of antibacterial resistant superbugs in the food and healthcare segments are sequential manifestations of our trying to improve the overall market's risk-return character. We are trying to get the market to re-rate by reducing risk that we cannot diversify away from. Next slide, please. Today, there are more than 100 such risk mitigation campaigns, which we call beta activist campaigns, both because they target the broad market, they try to affect beta, although the finance professors in the audience will tell me beta is a constant. I will say, yes, it is 1.0, but what that 1.0 represents in the real world varies according to the market. But we also call it beta activism because rather than trying to affect individual companies, beta activism distinguishes them from the type of alpha activism practiced by Carl Icahn or Nelson Peltz. Beta activist campaigns often involve collaborations of multiple investors and other stakeholders. Next slide, please. So, for example, the Climate Action 100, which Fiona is active in, and multiple other groups focus on climate change. The Guardians of the New Zealand Superannuation Fund have formed a coalition with more than 13.5 trillion New Zealand dollars, that's trillion with a T, to combat the use of social media by terrorists. Nordea, the large Nordic universal bank, and the Shareholder Commons, a US NGO, have focused on decreasing the use of antibiotics to fight antimicrobial resistant superbugs. And everyone from State Street to legal in general have pushed for better diversity on boards. We calculate that this type of campaign, designed to mitigate systemic risks, has increased the value of capital markets by 2 to 5%. That's more than 5 trillion globally, based on the size of the managed capital markets today. But ultimately, the value of beta activism focused on systems issues is much more than that. As Scottish social entrepreneur and the former head of Hermes Equity Ownership Services, David Pitt Watson noted when he read a draft of the book, quote, activism is there to ensure the proper use of entrusted power. Without it, capital markets will fail. I thank you. I hope that provides context for today's discussion.
Thank you very much, John. Yeah, that was great. I remember I've heard you talk about this for several years now, and it's a very powerful way of thinking about why it's in the self-interest of these asset owners to behave this way. Fiona, I'm going to turn it over to you at this point.
Another Scottish social entrepreneur, I hope. Thank you, John. And so super interesting. And I've been thinking and approaching this same topic from a different angle. So reading John's books and talking to John has given me lots of light bulb aha moments and sort of putting this agenda together. So let me come at it from a different angle, but I think we come to the same place. So just quickly to give you a little update on what's been happening in the pension world post the pandemic, and why this is so important, not just for short-term recovery, but the long-term recovery towards sustainable development globally. So next slide. I think actually it's actually been what I'm calling the pension pandemic paradox has been happening in the last year or so. As we've had huge social issues, unemployment rising, real need from people as they've lost their jobs, the huge changes in the economy globally still going on in many of the countries that we work on. A lot of people that their pensions is their biggest asset. And it's very difficult to say to someone to lock your money away if you really have emergency needs today. So understandably, there has been some access to pension funds, particularly in countries where there isn't, for example, unemployment insurance. But that's also, unfortunately, in some countries, that's really opened the Pandora's box. And there's been a lot of liquidity come out of the pension funds. Some of you will know Chile is the big poster boy, has been in the past of pensions, but there's been a huge withdrawal of money from the pension funds in Chile, which is short-term, very politically popular, but really erodes the pension funds. About $50 billion have been taken out, and almost half of the pension funds in Chile now have no savings in them. So people are having to rebuild from zero. So huge questions of access. At the same time, when we're really going to need that really precious long-term domestic capital to rebuild our economies going forward and to meet the sort of SDG, Paris and social goals that John was talking about, to address these systemic risks, we also need to invest in them. So on the next slide, what we saw was actually go to the next slide. I think we'll skip this one. We've seen actually some of the pension funds stepping up and actually providing the capital that was needed for the short-term immediate response to the pandemic last year. For example, the Dutch pension funds invested in pandemic bonds that were issued by some of the Norwegian development banks. We saw the CDPQ, which is the pension fund in Quebec, putting up funds to support some of their local SMEs, their local small companies in their home region. Even the Agricultural Bank of China issued a pandemic bond to try and fight corona at its sources, some of the food chain, etc., issues that were there. And we at the World Bank, we're a development organization. We provide loans to our countries. We provide technical assistance on policies across a range of different policy topics to the countries. But we also issue bonds in the market. And a lot of the bonds that we issue, the World Bank bonds, then go to support the recovery vaccine programs, etc., in our countries. So the pension funds have played a really important counter-cyclical role, providing the capital when it was needed last year. And then next slide. But it's not just now in the immediate response. We're going to need investments over the long term to really address the kind of systemic risks that John was outlining. The estimates for what we need to spend in emerging markets, particularly in developing countries, which really need the capital to meet the SDGs and the Paris goals, something like 4 trillion is the annual need that's estimated between here and 2030. We're spending about 1.5. So the estimate before the crisis was there was a gap of about 2.5 trillion a year. The OECD think that's actually gone up because of the pandemic to around 3.2. So these are big numbers. And it's interesting if you look at where is the capital, as John was outlining, Alicia, as you were mentioning, where is these big pots of capital that we're going to need to make these sort of investments? And if you look, the institutional investors around the world, the pensions, the insurance companies, this is actually a couple of years old, they're actually now up to around 100 trillion in assets. That's bigger than our global banking sectors. It's bigger than the stock markets, bigger than the government bond markets, which are some of the biggest asset class that many of you investors, I'm sure listening today, will hold. And the little tiny dots right here on the right, that's what we have, the institutions like the World Bank, the Asian Development Bank, the cumulative assistance, concessionary finance. It's tiny, it's absolutely tiny. We can't fill that gap alone. All the development banks together maybe have about 10% of that 3.2 trillion that we have each year in loans collectively. So we can't do this on our own. We have to have, as Alicia was mentioning, partnerships. John, you mentioned collaboration. We have to work with other investors and other types of investors to really direct the capital to where it's needed. On the next slide. And not very easy to read, but if you think about, John was saying that this really good beta activism, impact investing, we know ESG and is coming into many investors' agendas and started being built into their investment strategies. But if you look at the funds that really are explicitly impact investors, it's absolutely tiny. It's the little tiny blue bars over on the left. This is what my colleagues, their sister organization, the IFC, were estimating. Funds that really explicitly say they have an impact agenda and measure impact, it's less than $1 trillion. And that compares to, if you take just the 10 biggest public pension funds in the world, like the GIPF, Alicia, as you mentioned, from Japan, and the 10 biggest sovereign wealth funds from globally, the Norwegians and all the global, some of the biggest sovereign wealth funds, that's 15 trillion. So it absolutely dwarfs the explicit impact investing that's out there at the moment. So it's a very good trend, as John is saying, but really this needs to be mainstreamed for us to really start to address the systemic issues and to meet the investment challenges we need to close that financing gap for the SDGs and for the Paris Accords. On the next slide. And we're starting to see this, I think, is also, John sort of mentioned that, this is impact investing. It's not new in some sense that a lot of the very big funds around the world have had this idea of being universal owners. Because they're so large, as Alicia was outlining, the GIPF in Japan having over 1.5 trillion now, they have to own the whole economy. So it's not just the modern portfolio theory, diversification is not possible. These funds have an even bigger challenge because they're so big and because they really cannot diversify away from the markets. So what we've seen is these funds taking just a small amount of their portfolio and really investing in their local economies. You can think of it, the activism that John's describing, almost like a farmer buying fertilizer, putting it into your economy, like the GAPF in South Africa do, 1% of their portfolio to support local businesses, local Black economic empowerment, local social causes. That supports the economy, which allows all the other flowers in their portfolio then to bloom. Some of the local pension funds in London, in my hometown, are doing this. They've taken, again, 1% of their portfolio and investing in social projects in London to support the economy and the community who are the members of their funds. So it doesn't have to be a huge slice of the fund. Even a small amount can have a big impact, and particularly coming back to the idea of collaboration. So we go to the next slide. What I would say, just a question for you. How many of you know what is the 17th last, often forgotten, Sustainable Development Goal? Now, we all know about the pictures of the fish and the land and the education and it's actually, if you go to the next slide, click. The last one is actually partnerships. And I would argue, if you click again, that actually number 17 should actually be number 1. Because if we don't get that right, we're not going to meet any of the rest of them. Next slide. So we're working to put these partnerships of these big pension funds, these universal owners together. So these are some examples. We have some of the large public pension funds in the US wanted to invest in Africa, but they don't know the African markets. They don't know the opportunities there, the investment opportunities so well. So we took them to South Africa, to Kenya. The local pension funds know their markets, but they're not experts in investing in new asset classes like infrastructure, for example. So putting them together has been very powerful to then start to unlock and invest in new areas, including the ones that will contribute towards the sustainable development of the economies in future. We have a similar partnership with supporting the big provident funds around the Asian region, the Pacific Islands. That's the world's most glamorous central bank governor, who I met in Samoa. And this is the group of the pension funds in Kenya, the KEPFIC group we've been working with, again, to help them invest in larger infrastructure and other sustainable development projects. Next slide. I'll go to the next slide again. So just to finish off, I think there's lots of really innovative instruments coming up to help the funds make these types of investments. Many of you will know green bonds. The green bond market is very much growing. Still, I think, lacking from emerging markets and from the developing country sovereigns that need the capital. It's a very interesting way we found to get investors to invest in countries that they wouldn't necessarily have done so before. So we have been supporting countries like Fiji, had the world's first blue bond, for example, which attracted a new set of investors to the country that they wouldn't have done before, ring fence for specific projects that contribute towards sustainable development. And then very interesting ideas around not just debt, but equity. This idea around of natural asset companies. Could you recreate something like a national park? Think of it as more of a company. You put equity in to support the park, and the value is not just the revenues you can get from tourism or even carbon credits, but the value of the asset of the park itself, the value of the biodiversity, the value of the land, what it can give us in terms of contributing to the systemic risk reduction that John was talking about. So really interesting ideas out there about how we can start to rethink about these risks, revalue these assets, repackage them as investment products, and get our universal owners to start to lead the charge to meet the gap that we need in financing to meet the SDGs and the Paris Accords. So interesting ideas, I think, bubbling away, and happy to discuss some of those. Thanks, Alicia.
Thanks, Fiona. I promised at the outset that this discussion would be incredibly complex and wide-ranging. And so I'm going to lead off with a rather softball question that's rather closed-end, but I think it's important. I often get the question of, given it seems painfully obvious that improving or de-risking the market, as John would say, is a good thing for all asset owners, why has it taken so long for some of the really interesting and original ideas that you're talking about, Fiona? Why has it taken so long simply for universal asset owners to understand that they need to do this? Why has it taken so long? Maybe John thinks it hasn't taken so long when you look at when the Paris Agreement, was signed. But how would both of you answer that? Whoever wants to go first.
Well, I would say that I think the idea of universal ownership, universal asset owners, has been around for a while, about 15 years or so it first came together. And you've seen the leaders, the GPF in South Africa is a good example of a leader that's been doing this for 20 years. So I think the concept's been there, the leaders have been there, but I think the really broad understanding of the role they can play and the power that they have, I think is starting to come through. And equally, we haven't had the tools to really start to measure things like climate risk before. We haven't had the methodologies. And I always like to say, you've heard me say before, nature is the new climate. I think we also, it's even harder to measure nature risks, nature value, given it's not just one number, it's not just one temperature change. So we're just starting to work out what the tools, what the valuations are. So I actually think the market's moving pretty quickly and people are picking this up fast. And there's an inflection point, I think, happening at the moment, both in regulation and in change of action. But it's been bubbling away for a while. I think we're really starting to motor.
Yeah, I'll ask John to answer the same question, but I mean, you've touched on the issue of measurement, and we have to come back to that later because that's obviously a very complex and important thing. But how do you feel, John? Why is this suddenly, it seems to me, why is it suddenly, all the rage to talk about systemic risk, systematic risk?
So I think there are a couple of points here. And at first, I'd be remiss if I didn't say my co-author, Jim Hawley, sort of wrote the book on universal ownership. So, to Jim's credit. The reality, the other thing that I think we have to mention is just the capital markets have changed. We said MPT struck a revolution. The classic picture of what an investor is, some man, and it was usually a man then, standing around and looking at financial tables and calculating an individual company. People don't invest that way now. They buy the TSX, they buy the S&P 500, they buy an aggregate bond portfolio, right? And when you do that, you become much more aware that your returns are being affected by the overall market, by the systematic risk in the capital markets caused by systemic risk in the real world. The second thing is we actually didn't know about a lot of these systemic risks. I mean, we didn't talk about climate change 2 generations ago because no one knew about climate change 2 generations ago. And so it takes generational change for these ideas to work their way through the academy in particular, through the B schools and the finance literature. Second, for people to adapt to it. In effect, our book was pretty easy to write because people were doing it. Institutional investors were doing this sort of concern about systemic risk and trying to do with something, and practice had led theory. This is the first unified theory book. It's a finance book. It's not a ESG book per se, that examines what practice was doing. I mean, I was involved in the founding of the Ceres Coalition, which is a major NGO dealing with sustainability issues. And I'm trying to remember, but it was like the mid 80s. And so, and that was it clearly dealing with these issues. Fiona mentioned South Africa. I lived through investors dealing with apartheid issues. And so the issue was that somehow people assumed these were sequential political judgments rather than sequential risk mitigation efforts. And clearly, I'm not going to be devious and put my head in the sand and say that no one has any political agendas. But from an investor point of view, they are risk mitigation issues. So I think it's just capital markets took a while to develop, for people to understand what universal ownership was, for the finance theories to catch up with reality, and for the academy to catch up with it.
Yeah, I think one of the reasons I was so excited to have you both on is because you're both so compelling when you talk about this is not a political issue. This is an issue of profits and of growth and of risk mitigation. But as you point out, John, and as I'm sure Fiona has definitely had to deal with, politics is a real impediment to this, right? And that's why your arguments, I think both you and Fiona, are so important. We need to prove that this is all about risk mitigation and profit and growth rather than imposing values. And I think there's been a lot of confusion around this, right? So remember this book, Winners Take All, that sort of argued that this is not for, rich asset managers to decide what kind of issues we're going to pursue. This is for the government. Even if you kill that argument and say we're all in this together, that private industry, the public industry, there's still a question of who defines the priority and what do we do with transitions of industries. So I'll get off my soapbox in 1 minute. But for example, as I think you both know, I'm involved in an NGO that is trying to reduce lead pollution, which is an incredibly lethal element that poisons 1/3 of the world's children. And it's entirely preventable, and it wouldn't even cost that much to clean up. And we often feel we're in competition with the plastic guys, right? Plastic is definitely an issue, but it doesn't have the same immediacy and lethality, that lead does. Lead, going back to transitions of industries, we'll always need it because car batteries are going to be in need for many years, and lead is used in solar panels and wind panels and telecom. So again, I guess my question to both of you is, how do you keep the discussion focused on the financial issues? How do you deal with these issues of politics we all see in the pension systems? I remember that in 2018, the government employees who were part of CalPERS pension system voted out the fund's president because she had been prioritizing ESG policies over short-term returns. And we've seen that, John, in New York City pensions with the firefighters and so on and so forth. So how do you keep the focus on the key issues of risk mitigation and growth? How do you get the politics out of it? And even though you both have been so thoughtful in the list of issues that you deem critical for risk mitigation and growth, but how do you prioritize them? Who wants to go first? You're muted, John.
I muted myself, sorry. I think market forces are very powerful over long time periods. And that the example, I think, is you saw the Department of Labor in the United States in 2019 try to put forth a rule that would disadvantage funds that took these issues into consideration. 94% of the replies were critical of that rule. The market has changed. I don't think you can, I know that was how the CalPERS election was portrayed, but there were other issues in that one. In terms of New York City, I will tell you that the presumptive New York City, for those of you on the phone who don't live here, the comptroller of the city of New York is the investment advisor for 5 pension funds, totaling nearly $200 billion. The presumptive nominee, because it is a town that is overwhelmingly Democratic, he's a Democratic nominee for an election that will take place in less than a month, actually has endorsed systems level investing in his platform. And he actually was nice enough to come to my book signing, but that's a different issue. And so I think that you are seeing, just as no one would say, I don't believe in diversification, hopefully in 10 years, no one says, I don't believe that we don't have to mitigate risk in the world. That things don't progress in straight lines. You're always going to have some back and forth. But I think, as you said in your earlier question, you're hearing this all over today. And that is the change that wasn't there 5 years ago.
Sure. Yeah, and so for Fiona, there are countries that are, how can I put it, maybe not doing as much as they could in terms of carbon reduction. China, India, Saudi Arabia, Turkey, they haven't submitted climate targets ahead of the upcoming COP meeting. Australia seems to be wedded to coal still. And there are other politics that interfere with, some of the sovereign wealth funds and pensions that you mentioned, many of whom are political appointees, right? Whether it's pension or SFWs. So what incentives can global organizations give to achieve better unity around some of the issues that you've identified that you need pensions to work on, pensions and sovereign wealth funds?
So I think, in first of you saying about the prioritization, taking out the politics, I think you can't underestimate the importance of the SDGs, of the Sustainable Development Goals. Now, we can all throw stones at them. They're not perfect, not pretending they are, but having a global agreement for what is sustainable development, which is basically living within planetary boundaries of the environment, and trying to avoid excessive levels of income inequality is what it boils down to. We now have a boiled down version of what sustainable development is and goals that we are working towards. And then Paris with the climate was very specific too. So that's incredibly important for us to have, that gives us a framework. Now, underneath that, I think, as you say, things are developing, things are moving, we get new data, new information comes through all the time. I like to talk about going from the old adage of unknown unknowns to known unknowns. So again, we started with climate. We say we didn't realize it was necessarily a problem X decades ago. Then it was like realized it was, and then we found a way to measure it. I think, as I say, nature is a similar thing. We didn't even, it was an unknown. We didn't even realize that we should be valuing the natural capital of a country before. Now we kind of know we should be doing that. The Das Gupta report, which many of you will know is the big biodiversity report, like the Stern report was for climate, has this very compelling chart showing that a produced capital like GDP has gone up like this in the last 40 years. Human capital, our own development of education and health, has gone up like this. And our natural capital has gone like this. It's like 40% down in 40 years, basically. Now we realize this is an issue. We need to be thinking about the value of this. And I think then we've gone from an unknown known to a known unknown. How we do that then is a question going forward. So I do think we have a structure for thinking about overall what the priorities are. We have new information coming through all the time for how we value them. And then I think it does come down to the strategy and the choice of a fund or a company. So I think it's really important for each fund to have a very strong strategy. Think about ESG. How are you going to bring it into your own investment philosophy? Which topics are the most important to your members, for example? And that'd be different by country. It'll be different by fund. So one of the Dutch pension funds, for example, did a very interesting survey of their members to say, which of these topics are your priorities? What do you think we should be investing in? There's the big, I know you've been following the Make My Money Matter campaign in the UK, which I think is super interesting, empowering people through their pension funds, but giving people, the members, a voice to say which of the many topics we could work on do we think we want to really direct our firepower. So I think we have structures, I think we have better data, and I think we have more empowered members that help us then prioritize.
I knew that we were going to need 3 hours for this discussion, and we've got like a dozen really great questions in the chat. So I'm going to try to give one to John, one to Fiona, and hope that we have time after that to get to some more. So there are two questions which I'd like to try to link. My good friend and classmate David Barron in Tokyo asked, I think this is for John, how do you get politics out of it when you compensate people, I think he means asset managers, on the short-term returns? And another question, which is anonymous, is more about the free rider. It says, if you have people who are really working hard, whether it's legal in general or some NGO, to reduce market risk and address growth, all market participants will enjoy that benefit of activism. And doesn't that imply that individual investors have a small incentive to engage in such activities? It's a classic free rider question. But could you take those two, John? And then I have one for Fiona.
Sure, and if you don't mind, I'd also like to take some you didn't ask, because I think it leads into those two. There were a series of questions in the chat about how systems level investing works with MPT. And what I'd like to say is they are both tools. MPT gives you a great tool to extract the best possible risk return profile from the existing marketplace. What systems level investing does is try and get the marketplace to re-rate upward. Think of it this way: if you're an investor, if you're technical, and you want to improve the Sharpe ratio of the overall market, the unit of risk per unit of return, then you can apply MPT to a higher level that you're starting with, so everyone wins. And I think that gets to the free rider and David's question, which is the following. Number one, let's just for a moment assume that we're correct, and thus far the re-rating has been 2 to 5%. Asset owners, clearly universal investors, I think people are pretty convinced they should be acting in this way. Second, it's not that expensive to do. The reason that I mentioned coalitions and collaborations is, yes, it is more impressive if you would approach a issue with $30 trillion than with 10 billion. But the other thing is it spreads the cost of that initiative. And what are the costs of that initiative? They're usually letter writing, personnel, letter writing, I'm showing my age, email writing, personnel, research. They're not that expensive. And so if you're an asset manager, we even have in the book the calculation of take your net margin that you desire, what's your asset-based fee, what are your assets, figure out 2 to 5% of it. That sort of tells you what you should be spending, almost like an insurance policy, to make sure that AUM doesn't disappear with the market re-rating downward. So A, not that expensive. B, there are ways to decrease your cost of being a free rider, decrease your cost and therefore decrease the commons issue, which is the flip side of the free rider issue. And that is one reason I think why PRI now has so much assets under management and so many people. It's not A, you have to do it. B, you can't sell a fund in Europe right now unless it's an 8 or 9, which are the classifications of green funds. If you try to sell a Section 6 fund, no one's buying. And so there are pecuniary reasons to do so, even from a short-term asset manager's point of view.
Great. I'd like to go back to something that Fiona touched on, which is she was talking about this campaign in the UK called Make My Money Matter, which gives individual people enrolled in a pension plan the opportunity to say something about what they want from invested companies. So Fiona, let me direct the question at you. This concept of shareholder democracy has become rather hot because there's been recently there's been a big transaction company called say.com, which was set up to enable retail investors to vote their shares and make their questions to management, was bought by Robinhood, was acquired by Robinhood for quite a tasty price. And then we've had the ETF launched by Engine Number One, the activist that got the director on the board of Exxon. They launched an ETF called Vote. What do you make of this movement to involve retail investors in voting and in activism and engagement? Because what we see in politics, at least in my country, is a reminder that a well-functioning democracy requires an educated citizenry. What do you make of this movement towards shareholder democracy at retail level?
I don't think the Brits have any comment on that at the moment from the other side of the pond, but anyway, politics aside. So I think that's why I think the institutional investors have a very important voice, because you're going through your pension fund, so you're doing it collectively, and these are, as I say, the biggest investors covering now with the auto enrollment in the UK. It's huge numbers of people now are actually part of the pension system, and you're going through managers, investors, people who do a lot of this research, etc., for you. So you're pushing them to then do the activation. So I think that's really positive. Can you have, and then I think it comes back to, as John's saying, are you working towards systemic risk, or is it really individual activist issues that are being picked up? And that's a different issue. And that worries me a little bit if the retail is being used and pushed for those individual short-term issues, just like Robin Hood is more about, you can argue it's about short-term return and practices and leverages and stuff, which are not supportive of long-term trends and long-term financial health. So I think there is a challenge here, but I think the big pension funds have a really important voice in their way to represent really big parts of the population. And I think that's a very positive way to go.
Yeah, on the other hand, like I work closely with an activist who is in Japan. I mean, they're not in Japan, but they're working in Japan, who are working very hard to establish certain standards of governance and transparency and so on. And the fund manager, and I always ask the fund manager why he's doing that. And his answer is he's trying to make a return for his investors, and that he can only solve the problem one company at a time. And while an investor, whether it's LGIM, Legal and General, or whether it's BlackRock on climate, I mean, that's how it happens, right? One company at a time. Yeah.
That's why I think the Climate 100, Action 100, the nature, what we're talking about, you target the companies. Then which companies are you going to target? So it's likely the Nature 100, we're trying to do the same thing. Which are the biggest 100 companies in the world that have the most negative impact on biodiversity and nature loss? Target them. So again, it's which companies are you targeting for which topic, I think is again another way to channel and have influence.
Yeah, given your background, both of you, and your interests, both of you, and your expertise, both of you, it's really hard to find a quick question, an easy question, or a short question to ask. But we've only got 5 minutes, so I'll lead with an impossible to answer question, which is most of my students feel like the thing that you should do is divest, get out, sell those oil companies. But as we discussed earlier today, what does that matter if PE companies are buying them back and like not holding the managements accountable for transitioning? So this is not fair at all. It's totally unfair. But can you each give me 2 minutes, let's say, on the argument about divesting things that are bad, quote unquote bad, or engaging, what is the choice, or totally excluding them from the get-go? How would you answer those? You can start, John, and then Fiona. But John, I will cut you off after 2 minutes because we literally have.
Sure. So I'm actually writing an op-ed, an opinion piece on divesting right now. So I've thought about this a fair amount. There are people who want to divest because they want their investments to be aligned with their values. That's fine. That's not a fiduciary argument, though.
Right.
So divesting to me takes all the air out of the room for a lot of other arguments. It does one thing, we talk about it in the book, is it is part of what we call private sector standard setting. It sets acceptable bounds. It does not, except on the margins, when you divest from a secondary trading equity market, necessarily affect the cost of capital that much. If you really wanted to do that, you should divest from the commercial paper market or from the bond market. That being said, it does set standards and draw attention, and it can be used in conjunction with, we outlined 10 tools of intentionality, which come from the Investment Integration Project. It is to us a subset of standard setting. It can be used in conjunction with the other stewardship tools. And it does work in that way, although there are obviously in certain situations feedback. So for instance, you mentioned Engine One. For those on the call who may not know, Engine One fought a proxy battle at ExxonMobil and won 3 seats on the board. They had asked for 4. And the analysis is, had more sympathetic funds not divested from Exxon, they would have won all 4. And so it goes both ways. So my argument would be divestiture is a legitimate tool, but it is not the only tool. It should not take all the air out of the room. It is useful for saying what is acceptable behavior, but there are other ways to do that as well.
Yeah, so Fiona, I give the last 2 minutes to you. If you want to answer this question, please do. If you have other thoughts that you think are more important, please, you have a carte blanche.
So I think you have to think about divestment different. I agree with John, it's a simple answer. I think you have to think about divestment differently when it used to be a small number of activists, and now it's going right across the market. It's systemic. We have to think about it differently. It's the first thing I would say. I really like this transition concept that's coming in. I think this is really powerful. I think it's incredibly important for the countries that we work in. One of the things, the final thought I'll leave with you with, which I think is really important, is although a lot of this ESG we think is incredibly important, is doing good, we want to drive capital to the countries and the companies that need it most to meet the SDG goals. However, many of the indicators are very linked to GDP, and you could have the unintended consequence of actually driving capital away and back to higher income countries. So this idea of transition is really important, and a lot more work needs to be done. There
are a lot of questions. There's a lot of comments in the Q&A that are interested in having your slides or a recording, will there be a recording of this? And I just want to say to everybody on the phone, on the camera, on the webinar, yeah, please just reach out to me. If you have, there are a lot of questions we didn't have time for, please reach out to me and I will get in touch with our speakers and get their feedback back to you. Please ask for copies of the slides. We will take care of that. And as for the recording, it's generally available 2 to 3 weeks after the event. You can look for it on our YouTube channel, or you can look for it on the CJEB website. So it just remains for me to thank both of our speakers. And yeah, I think we could have gone on for at least 2 more hours. So we'll try to have to arrange to do that. And I want to thank the CJEB staff who always makes this go completely smoothly without any hitch. And I have only a small appreciation of how hard a challenge that must be. So I do want to thank all of our sponsors at CJEB, all of our financial sponsors. They are not only sources of financial support, but I always like to say they are priceless sources of advice and sources of information for us. They inspire a lot of the research that we do. So I want to thank all of them. I want to thank everybody who tuned in tonight, and I'm really hoping to see all of you again at our next event. So thank you very much. I hope you have a good evening on this side of the ocean, a good morning on the other side of the ocean. Thank you.